As you know, we're very much value style investors. So, we're looking across the market and trying to really work out where the value is and where we perceive there to be some growth. Traditional media is an area I think it's unloved, particularly in Australia, just because there is perceived to have been obviously a bit of market interruption coming from the online providers. So you'll see, for instance, REA Group and Seek and those sort of businesses, they trade on about 25-30 times earnings. So obviously there's a lot of growth that's factored into that share price. But what one of the areas that have been left behind is traditional media. So companies like Seven, Nine, APN, Fairfax, all those sort of traditional or more traditional businesses, the sector's trading on about 10 times earnings. And so that was the first thing that pricked our interest, was just that inherent value there that really deserves further investigation. The second thing that you get when you're buying businesses on low PE multiples is a higher dividend yield. So just because of that value, the sector broadly yields about 6.5–7% when you include franking. Certain businesses within that sector, so for instance Seven West and Prime TV, which both distribute Channel 7 content, they've got a grossed up yield of about 10%. So that is why we looked at those, and then from there it's really just getting comfortable with the business, with their cash flows, their balance sheet, etc. And on that basis, we looked into it, and it's an area that we are increasingly comfortable with.
Okay. One of the things that the traditional media players are facing is what people are perceiving as a structural shift or disruption from the online players. Where do you sit in terms of how that's playing out?
Well, I definitely think it's an issue that needs to be considered. Obviously, the growth in these online businesses is huge and can't be ignored. And the other thing too is you can really quantify the return that you get for your advertising dollar through online. So you can see the clicks and things like that go through to the end, the end sort of seller. With the traditional media, it's not that transparent. However, I really believe, especially in Australia, who we are quite savvy with online, and it's becoming a more mature business, and it's certainly more mature than it is in a lot of areas offshore. And so that's why you're seeing, for instance, Webjet or Seek and those sort of businesses that have a mature client base in Australia. They've got to go overseas for to really grow their earnings and to hit those earnings targets that analysts have given them. There is obviously risks that come from them, and so it's just really getting comfortable with the price that you pay for traditional media. And I just think where we are in the cycle, and the fact that people will continue to advertise through traditional media networks, it's just how they will use them and how they can quantify that may be the issue.
Okay. You mentioned earlier that you feel that you say traditional media is sort of directly correlated to retail strength and how the retail consumer is behaving. Just explain how you're viewing that cyclical play there.
Yeah, well, I mean, that's one of the real key drivers to the traditional media space is advertising, obviously, and retail accounts for about 40% of all advertising that's done on traditional media platforms. So, our view is that, especially since the budget, and we think the theme is continuing, that people aren't spending as much. Unemployment went up recently. They changed the way they calculate that, but the number wasn't great. It doesn't matter how you cut it. So, with people not as confident as they could be, that obviously curtails their spending, and as a function of that, the retailers just don't have the same budget to spend on advertising. Once people start spending more, and it will happen, every cycle has its peaks and troughs, people eventually will start spending more at retail outlets, and we believe that once that occurs, then advertising budgets will be increased. Some of it will go online, but some of it definitely will go to these traditional media companies.
Okay. Just a picking up on a point you mentioned earlier, you talked about the yield that these companies are paying.
Yep.
To what extent are their earnings sustainable enough and defensive enough to sustain that yield and there not being a value trap as opposed to perceived value?
Yeah, and that's the issue. And I think a lot of people in the market think that traditional media is in structural decline. And I agree to a certain extent with print media, because it's all being viewed online and on mobile phones and things. But some people just still prefer reading newspapers. When using Seven West as an example, their revenues have stabilised. The cost out story is significant, and that's where most corporates are looking to sustain their earnings, because top line revenue growth just isn't there anymore. But we had a look at that. Seven West has 40% of the viewers, so their ratings are the best in the market. They've maintained that position for, I think it's the last 14 reporting halves, so for the last 7 years. The risk is obviously being the number one guy that could be at risk. But yeah, look, we've had a look at it, and they've maintained that position, and their revenues have been quite solid. The other thing too is just the payout ratio. So their payout ratio is about 70%. So there's a little bit of leeway should something occur to their revenue stream that they can withstand some weakness there before they have to cut their yield.